Hey everyone, welcome back to Corporate Decoder, the place where we unpack the secrets hidden in plain sight within company filings. And today we're looking at a company that is apparently dealing with its compensation in a rather creative way. Get ready for a peek behind the curtain at Bluerock Homes Trust Incorporated. This isn't your typical deep dive into quarterly earnings, but an interesting look at how a company is handling payments and incentives, especially involving its top brass. Let's get into it. Scroll SA Securities and Exchange Commission Center. First off, this is a Form 8K filing, which is basically a report used by public companies to announce major events that shareholders should know about. Think of it as the company shouting out important news. Our company here is Bluerock Homes Trust Incorporated, a real estate investment trust. They're focused on the housing market, which has seen its fair share of ups and downs lately. They've got class of common stock trading under the ticker BHM on the NYSE American Exchange. This is the stock most investors would be looking at. Now, Bluerock Homes Trust is identifying itself as an emerging growth company. This generally means they're relatively new to the public scene and are allowed certain flexibilities in how they report their financial information. The core of this particular filing falls under item 3.02, which deals with the unregistered sales of equity securities. Essentially, this means they've issued stock or similar instruments without going through the usual public registration process. Usually, this happens when a company is paying for services or in specific acquisition scenarios. And in this case, it is all about securities for services. Bluerock Homes Trust has been paying for management services, not just with cash, but with something called CLTIP units. Let's break down what's happening here. Bluerock Homes Trust has an external manager, Bluerock Homes Manager LLC, which handles its day-to-day operations. This manager gets paid a base management fee. Normally, this fee is paid in cash. However, the agreement allows for a portion of this fee to be paid in these special CLTIP units at the election of the company's Board of Directors. For the fourth quarter of 2025, the board decided to pay a part of the management fee in these CLTIP units. The value of this portion was calculated by taking the dollar amount of the fee and dividing it by the average closing price of the company's class, a common stock over 5 business days before the issuance date. This whole structure is designed to align the interests of the manager with the company's shareholders. By paying in units that can eventually turn into company stock, the manager has a vested interest in the company's stock performance. Now, things get a bit more interesting. The executive management team, specifically the CEO Mr. Raman Kamphar and President Mr. Jordan Ruddy, decided to take a portion of their salaries not in cash, but in these CLTIP units. This was done to reduce the manager's immediate cash outflow and to better align their personal interests with the company's shareholders. So, what happened is that a piece of the management fee, originally intended to be paid in CLTIP units to the manager, was instead directly issued to Mr. Kamphar and Mr. Ruddy. Mr. Kamphar received units valued at $150,000 and Mr. Ruddy received units valued at $60,000. This was in satisfaction of the manager's obligation to reimburse Bray, an affiliate, for payroll expenses related to paying 80% of their base salaries for the fourth quarter of 2025. On the 18th of February 2026, the actual issuance happened. A total of 22,252 of these CLTIP units were set to be issued. Of these, 15,894 went to Mr. Kamphar and 6,358 went to Mr. Ruddy. This effectively means that instead of the company paying the manager cash, and the manager paying its executives cash, Bluerock Homes Trust directly gave equity to its top executives to cover a part of their compensation that was tied to the management fee. Why did they do this without registering it? Well, the company is relying on exemptions from registration, specifically Section 4, R2 of the Securities Act of 1933, and Regulation D. These exemptions are typically used for private placements. The key here is that both Mr. Kamphar and Mr. Ruddy are considered accredited investors and have a pre-existing substantial relationship with the company. This means they are seen as sophisticated enough to understand the risks without needing the full public disclosure protections. What are the implications of these CLTIP units? They are immediately vested, meaning they belong to Mr. Kamphar and Mr. Ruddy right away. These units can later convert into OP units, which are a type of limited partnership interest. After a holding period, these OP units can be redeemed for cash or, importantly, settled in shares of Bluerock Homes Trust's class of common stock. This means these executives can eventually end up with actual company stock. On top of that, they'll receive distribution equivalents, which are essentially payments tied to the dividends or distributions the common stockholders receive, making them whole for any distributions missed while holding these units. And finally, the report is signed off by Christopher J. Vose, the Chief Financial Officer and Treasurer. This confirms the company is officially reporting this transaction. Now for my take on all of this. What we're seeing here is a company using its equity as a tool for executive compensation and management alignment in a pretty direct way. On one hand, this strategy of paying with equity, especially to executives, can be very effective in linking their rewards directly to the company's performance. When the stock price goes up, their own wealth increases, creating a powerful incentive to drive shareholder value. It also conserves the company's cash, which can be crucial for a company in the volatile real estate sector. However, there are potential downsides. This maneuver, while exempt from full registration, still involves issuing new equity. If done too frequently or in very large amounts, it can dilute the ownership stake of existing shareholders. It is also important to understand that the value of these CLTIP units is directly tied to the company's stock price. If the housing market or Bluerock specific business falters, the value of these units, and thus the compensation of its executives, will decrease. The fact that the company is leveraging these exemptions suggests they are trying to remain agile, perhaps avoiding the bureaucratic hurdles of a full public offering for what are essentially internal compensation adjustments. The fact that the executives are accredited investors and have a substantive relationship is key to these exemptions, showing they are considered knowledgeable parties in these transactions. Ultimately, Bluerock Homes Trust appears to be using its equity strategically to manage its compensation structure and align its leadership with shareholder interests. The real test will be how the company performs and how these CLTIP units ultimately translate into shareholder value for everyone. The critical factors to watch will be the company's growth trajectory, its ability to manage its assets effectively, and how well this equity-based compensation plan continues to serve its intended purpose of driving long-term success. Alright, that is our breakdown of Bluerock Homes Trust's latest filing. What is your take on these compensation strategies and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more corporate deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.